Today, we're tackling one of those puzzles in the stock market that can be, well, both frustrating and fascinating. We're talking about a massive disconnect. We're looking at United Health Group, UNH, a real blue chip giant.
Yeah.
And the central question, which we've pulled from this very contrarian analysis report, is pretty simple.
Yeah, it's how can a dominant company like this be delivering double-digit revenue growth while its stock price is, for all intents and purposes, crashing?
It creates so much confusion. You look at the business and everything looks fantastic. Then you look at the stock chart and it looks like a complete disaster is unfolding.
Exactly. So we're diving into this analysis that argues this isn't a value trap, where something looks cheap, but it's actually just broken.
Right.
Instead, they're calling it a fat pitch opportunity.
And that's our mission today. We're going to unpack that argument, the idea that this whole situation is driven by market emotion, not financial reality. We're going to figure out what Wall Street is selling and why the company itself seems to be, well, figuratively buying.
We're just separating the noise from the signal and focusing only on the hard numbers that are presented in this analysis.
Okay, let's unpack this then and start with the obvious pain point first. That stock price decline.
Yeah, because it's severe.
It really is. I mean, if you just look at the chart, the market has treated UNH as if its whole business model has fundamentally imploded.
Right.
The data showing the stock is down nearly 46% from its previous highs.
And those highs were soaring past $600 a share.
And now we're just kind of sitting there consolidating around the $327 level. That is a brutal technical picture.
It is brutal. And a decline like that in a company of this size, of this stature, it's rare. It tells you that sentiment has just been driven by some pretty severe panic selling.
Wall Street's thrown the baby out with the bathwater, it seems.
It really does.
So, okay, we have this crashing price, which suggests something is fundamentally wrong. Let's pivot now and look at what the business is actually doing. How does this all connect with its underlying financial health?
The word the analysis uses is booming. And I think that's fair. If you look under the hood, the company is showing this massive, sustained growth, which is, incredibly difficult for a company of this size.
Can you give us the hard numbers on that surge?
We're talking about colossal figures. In just one quarter Q3, based on the data in the analysis, United Health pulled in $113.2 billion in revenue.
$113 billion.
In one quarter. And that represents a 12% increase year over year.
Let's just pause on that number for a second. $113 billion. That's not just a big number. That's like the size of a small country's GDP.
It is.
We're talking about a scale of operations that very few companies on the planet ever achieve. And they're still growing at double digits. I mean, that growth rate would be phenomenal for a young tech startup.
Exactly. And that's why this paradox exists. You have this fundamental reality of massive growth, overwhelming scale, and yet the price chart reflects this crippling doubt.
So that divergence is the core of the analysis report's thesis.
Right. That market sentiment has just completely lost touch with the financial fundamentals. Investors are running based on fear, not on that $113 billion quarterly revenue figure.
So if the business is doing that well, why is the price down nearly 50%? We have to get past the surface level fear and really identify the market specific concern here.
And the analysis points to one simple reason, which is really central to the economics of any insurance provider, especially in healthcare.
And that is?
Rising medical costs.
Okay, that phrase sounds a bit abstract. What does it actually mean for UNH? Why is the market so terrified of it?
It really just comes down to utilization.
Right.
So in the insurance business, the key metric is the medical loss ratio, or MLR.
Right.
This is basically the percentage of premium dollars that the insurer has to pay out in claims and clinical expenses.
So when people are using their insurance more for procedures, prescriptions, doctor visits, utilization goes up, and that MLR number rises.
Precisely. So if people are using their insurance more, the cost of paying claims goes up, and that gap between what they take in as premiums and what they pay out as costs, that margin gets compressed.
And Wall Street hates that.
They hate it. The market sees even a slight short-term increase in the MLR, and it just sells off aggressively.
Yeah.
Institutional investors, they prioritize predictability above everything else.
So that uncertainty about future claims costs, even if it's manageable, it gives them the excuse they need for a mass sell-off.
That's it.
Okay, so that narrative rising costs hurting profitability, that's compelling on its own. But this is where the counter-narrative from the company's own decisions just completely flips the script. This is where it gets really interesting.
This is the absolute crux of the bullish argument in the analysis. If the medical costs were really some existential threat to the profitability model, what would the company be doing?
They'd be lowering expectations, warning the market.
They'd be adjusting future expectations downward. But instead,
They did the opposite.
the company just raised its full-year earnings guidance. They actually bumped their expected earnings to $16.25 per share.
You just can't logically reconcile those two things. You can't have a company facing a fundamental business collapse while that same company is raising its financial guidance.
It doesn't add up. If costs were crushing them, they'd be cutting expectations, not raising them.
Raising guidance means they are confident they can manage those medical costs and maintain profitability, even with higher utilization.
And the analysis summarizes this perfectly. It calls the price drop a classic overreaction.
Yeah.
The market is pricing in this disaster scenario, right? Terminal damage from rising claims. But the company is actively projecting higher profits. It's a profound disconnection.
It really highlights a key dynamic in modern markets. Investors often prioritize the certainty of the immediate quarter over the proven success and long-term trajectory of the business. Uncertainty creates the liquidity event.
And that liquidity event, that severe fear-driven price drop, brings us right to the case for what the report calls insane value.
Right, because if the price is reacting to emotion and not the fundamentals, then the valuation metrics should be flashing green.
They should be.
Let's dive into those then, starting with the foundational one, the price to earnings, or PE ratio. For any listeners who need a quick refresher, what is the PE ratio really telling us?
Well, the PE ratio is simply how much money you have to pay for $1 of the company's current or expected earnings. A high PE suggests investors have high growth expectations. They're willing to pay a premium.
And a low PE suggests the stock is cheap relative to its ability to generate profits.
Exactly.
So what is UNH's current PE right now, trading at this depressed level?
Okay, so the current PE, based on historical earnings, is trading at approximately 17 times.
17. Now, that needs context.
It does. Historically, UNH is treated by the market as a premium, high-quality stock. Over the last several years, it has comfortably traded in a range of, say, 20 to 25 times earnings.
So we've already established that the current PE of 17 is a pretty significant discount to its historical baseline. The analysis report calls this a bargain basement multiple for what is still fundamentally a premium company. That's a powerful argument.
But this is where the argument gets insane, to use the source's word. We have to look at the forward PE.
Okay.
That's the ratio based on those raised earnings guidance numbers, the $16.25 per share they expect to earn next year.
And what does that projection show? What's the forward PE?
When you factor in the raised guidance, the forward PE drops to roughly 11 times.
11 times forward earnings. While the company is generating 12% revenue growth annually, that is an astonishingly low valuation for a market leader. I mean, to put that into perspective for you, the S&P 500 generally trades somewhere between 20 and 22 times earnings.
Right.
So you're getting a premium stock that is growing its top line at 12%, and it's priced at roughly half the multiple of the average large American company.
The analysis report describes that multiple as insanely cheap. And it's frankly difficult to argue with that when you see the numbers contrasted so sharply.
Yeah.
An 11 times forward PE severely limits your future downside.
Yeah.
You're basically paying a deep value price for a growth company.
Let me play devil's advocate for a second, though, because the audience deserves a balanced view here.
Please.
If this is so obviously a golden opportunity and the stock is trading at 11 times forward earnings, why haven't larger, smarter, faster institutions already piled in and closed this gap? What potential risks might the analysis be, downplaying?
That's the right question to ask. And the main risk that the market is holding on to, the thing driving that persistent uncertainty, is regulatory. United Health is massive, and healthcare regulation is always a political football. So the uncertainty isn't just about the MLR this quarter. It's about whether political winds might shift and impose new constraints on profit margins years down the road.
So the low valuation is basically a fear-based discount for that regulatory uncertainty.
Even though the company is currently navigating the existing environment very successfully. Yes.
That makes sense. So the market's discounting UNH not for its current performance, but for possible future political changes. But while Wall Street is debating those hypotheticals, the company is still generating tremendous cash flow.
Exactly. And while an investor waits for the market to, reconcile the price with the fundamentals, they're still collecting a very safe dividend.
A 2.7% yield.
Described in the report as safe, steady cash flow.
So you have a solid dividend that acts as a kind of structural support. It's paying you to be patient while the stock is undervalued. That's a pretty powerful tool against volatility.
It truly is. It's the yield you collect while you wait for the short-term noise to fade and the proven long-term quality to reassert itself.
So we have booming revenue, raised guidance, historically low valuation metrics, and a solid dividend. Let's move to the technical picture, because for listeners who might want to capitalize on this, the report provided very specific price levels.
Right, where patient capital seems to be accumulating. And the technical analysis really supports the idea that the worst of the decline might be behind us. The report identifies these clear zones, suggesting the value play has defined boundaries.
So what's the definitive bottom that the analysis identified?
Looking at the charts, the report identified the capitulation bottom. That's the moment of maximum panic.
Okay.
That was the massive bounce that happened when the stock briefly touched the $234 level. That's now the established structural floor for this recent decline. There's huge support there.
And what about where we are now, around the 327 area?
That is precisely what the report calls the accumulation zone. This is the price band where informed patient capital is slowly entering the stock.
So the consolidation at this level suggests that institutions who understand that forward PE of 11 are quietly building their positions.
They're recognizing that the price discovery right now is just heavily skewed by fear.
Okay, now let's talk about the potential return. This is crucial for determining if this is really a golden opportunity. What's the conservative target suggested by the analysis?
The analysis focuses purely on a reversion to the mean. It suggests that a sentiment just shifts slightly and the stock returns to its historical average valuation, even trading at a modest 20 times PE, which is still below recent highs.
Then what?
A return to the $400 level is considered conservative.
Conservatively, $400. And we're currently trading at $327. So that represents a potential 20+% upside, just to get back to what the analysis considers fair value.
Exactly. We're not talking about factoring in future growth or hitting new highs. This is just a return to baseline market sensibility.
It just illustrates how severely the stock has been punished.
It does. When a stock is trading at an 11 times forward multiple, the upside potential far outweighs the risk of more downside, especially for a company that is demonstrably raising its earnings expectations.
The report's final verdict is emphatic on this. It calls the situation textbook.
Yeah.
It describes a market where Wall Street just sells first and asks questions later, driven entirely by uncertainty around those short-term medical costs.
The final conclusion is that the drop is a golden opportunity to invest in a high-quality stock that's been, in their words, unfairly punished.
And the logic is compelling because the company itself has provided the strongest possible rebuttal to the bears.
They're facing the utilization problem head-on, they're raising guidance, and they're basically confirming that these rising medical costs are just temporary margin compression, not some kind of structural failure.
So, to synthesize the insights we've pulled from the analysis today, you have a company, UNH, growing revenue by 12%. It just raised its full-year earnings guidance to $16.25 a share. It pays a safe 2.7% dividend.
And yet,
the stock is trading at historically low valuations, including an 11 times forward PE, just because of short-term fears about temporary medical cost uncertainty.
it's a remarkable case study. It really demonstrates the often irrational nature of market movements when faced with uncertainty.
And this raises an important question for you, the learner, as you navigate these complex markets. The analysis report argues that Wall Street is prioritizing short-term certainty and fear over proven long-term fundamentals.
So emotion, not calculation, is setting the price.
Exactly. So how can one objectively measure the real risk of a company like UNH? Do you rely more heavily on current PE multiples and historical trends, which indicate extreme value? Or do you focus exclusively on these near-term margin forecasts, which suggest minor uncertainty but have caused massive price swings? And that balancing act, deciding whether to trust the historical average valuation or the immediate fear-driven volatility, that is the key difference between identifying a genuine value trap and seizing a golden opportunity.
Something for you to mull over as you compare the fear in the charts against the facts in the financial statements. That's it for this deep dive. Thank you for joining us.